This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, g'day. How you going? Phil Tarrant, host of the Smart Property Investment Show. How you going? Hope you're well. Dialing into our semi-regular discussion around mortgage finance. It's something which still dominates everyone's conversations that I'm having, and we all know that property investment is a game of finance. He or she who does the finance best has the greater utility and flexibility and scope to grow their property investment portfolio. One of the big things, and we've all been chatting about this for ages now, around serviceability constraints. Serviceability obviously has changed quite a lot as a result of the interest rate environment going north, and the fact that we still have these buffers put in place around mortgage lending. And you might have heard me chat about this, I was at a big roundtable with all the non-major banks recently, and essentially all the banks, all the ADIs, deposit-taking institutions that aren't NAB, Westpac, ANZ and the Commonwealth Bank, who really do well to serve property investors. One of the big topics of conversation was around buffer rates on mortgages, the fact that you're still assessed at 3% above what the standard variable interest rate is at any point in time, which is really curbing a lot of people's ability to borrow more or even reapply for other home loans. Sometimes those buffers, and we've spoken about this on this podcast, is relaxed a little bit for refinancing, but there's still a big issue around it. So what do you do about it? Well, the bank's rules are the bank's rules, and you're going to have to play within that space. Get yourself a good mortgage broker, because they'll certainly help you navigate that more effectively. But rate is one side of the ledger when it comes to your borrowing capacity. There are other ways to improve your borrowing capacity, which isn't necessarily hoping and praying that the banks will change their policy, rules and regulations. So I want to have a chat about that today. It's something we don't really talk too much about on the basis that this assumed knowledge of how you can increase your borrowing capacity, but it's good to get back to basics to work out how you can increase your borrowing capacity as a property investor, so you can best position yourself not only potentially to refinance and extract equity, but importantly to continue that property investment journey, whatever that looks like. And for most of you, it's going to probably be being what's the next investment property. Joining him in the studio, Eva Loisance from Finni Mortgages, so finni.com.au. That's Finni. Did I get that right, Eva?
Yes, correct. Fi. Yep.
You've been avoiding me for a little while now, and you've had some of your other very capable brokers on the show. I've had some great discussions.
Yeah, so I thought it would be good for people to hear about the other brokers we have and what we specialize in. And I think it's been good. Yeah, we're getting actually a lot of leads, people specifically wanting to talk to someone in particular to do their loan because they specialize more into self-employed or higher percentage lending or whatever it might be. So it's been good.
Yeah, it's cool.
I'm back.
I've really enjoyed the conversations, and they've been quite varied. Last chat I had with one of the Finni brokers on air was around special deals for professionals, these pro pack type deals, right? Where if you're a medical professional or an accounting professional or a legal professional, banks tend to view you with a little bit more trust than other professions. Now, the funny thing is that when you look at the list of most trusted professions, lawyers are pretty far down the list, normally with real estate agents and journalists. So I want to see a pro pack for journalists. We're going to be some of the most trusted people. We should be getting sharper rates, cheaper rates for journalists, I say. We're the most trusted profession. You probably can't see that I'm smirking right now, but anyway, for those lenders out there, how about a pro pack for journos? Bit cheaper, just a little bit, that's all. So we can increase our borrowing capacity. But let's kick off, Eva, with just a bit of a baseline. How does servicing work? Like just how does a bank look at this when they look at your serviceability?
Yeah, so that's I think where people get lost a little bit is, I often get, but I know I can service for it. I've got surplus every month. It's all fine. I know it's going to work. But the issue is the bank will take all your income, obviously apply some buffers and reduction to what you earn. They will take all your debt and apply buffers to that too, and then see what's left at the end. So you might be thinking, you've got an extra $2,000-$3,000 a month to apply for a new loan. But when the bank applies all those risk factors that could happen, at the end you minus $1,000 anyway on their servicing calculators. So people sometimes get a bit lost as to why the difference is so high. and where really is the sweet spot. So the question we get asked all the time is, how can I improve this? Where can I go? What can I do? Should I invest in my name, in a trust name? Should I refinance? Should I restructure? What should I do? So I think it's going to be a good podcast to discuss, because it's the question we get every day on a daily basis. What can I do?
So really simply, your serviceability is a mechanism of how much money do you bring in every day, week, month, whatever, annually, and how much do you spend annually, and how much is left over?
Yeah.
And then they work out, well, you ain't got anything left over, so you probably can't take on more debt, or you actually have a fair bit left over, so we can consider whether or not we're going to give you some more debt.
Correct.
That's the simple
Correct.
thing. Yeah.
Simple, but there's so many buffers, and banks apply buffers differently. And that's where we can play with banks and servicing. And sometimes, people come to us thinking they can't do anything because they've been told that by bank A, and then suddenly we can do and view things, I guess, differently and make it work.
Okay. We'll just go to a quick break. Stay with us, back in a moment. Welcome back. Phil Tarrant for Smart Property Investment, chatting with Eva from Finni Mortgages. That's finni.com.au. And sort of as a rule of thumb, and you hear these things bandied around all the time, but as a rule of thumb, how much debt will a bank or a number of banks provide to you before they go, that's too much debt? I know they normally base it against your annualized income. So as a rule of thumb, what would that be?
Yeah. Generally, when you reach 6 times what you earn. So what you earn is everything, your income, if you've got any government benefits, rent, dividends, everything you might earn, that time 6 times is really where you're going to start struggling for servicing. But again, these banks are a little bit more lenient, and that's, that income might be, let's say, $80,000 with a bank, the way they see it, or it might be $100,000 with another bank, the way they might see it. So it's very important to compare and understand what type of income you're getting and how it's seen by the bank. What percentage of that income they can take. Yeah.
So this is all the money that you bring in and how you show it, dividends being one of them, or, property investment income, they count as income, but sometimes they discount that, Eva?
Yeah, that's right. So some lenders would take 80% of your rental income. Some banks would take 90%. Some bank would actually take 75%, which seems really low. But in those 75%, they actually don't double up by adding your property expenses. So you might be better off going with that bank than the one that takes 90%. So it's really important to really understand what type of property you have. For example, if you've got units, obviously the expenses are higher than if you have a house, because you've got strata, because you've got different type of special levies maybe that are applying. So you might actually be better off going with a bank that will only take 75% of your rental income than the bank that takes 90% and then shave off a lot of that by adding expenses to it. So yeah,
it gets complicated.
It gets very complicated.
And again, good mortgage broker a good mortgage broker will go, well, if we go to X bank over here or X lender over here, they will count 100% of your property investment income as income, whereas this lender over here will only give you 50% of it. So, this is all in the policy settings and stuff. But another interesting point, and if you're a PAYG employee, your income's a lot easier to show. And, it's normally a PAYG payslip. That's pretty easy. Then you might have other investments. You might have some property which delivers income. You can show that quite easily. You might have shares or other investment vehicles that provide you a dividend. You can show that quite easily. Where it starts getting a little bit more complicated but has upside is if you're self-employed. And one of the biggest challenges, and talking about increasing or maximizing your borrowing capacity, something that I say all the time, or a lot of self-employed people don't understand, is that if you don't make profit in your business, it's very, very hard for you to convince a lender to lend you money on the basis of, like, your accountant might tell you that you can do all these legitimate tax deductions and all this sort of stuff to bring down the amount of money you have to pay the tax man. But the inverse of that is that is what lenders are going to use as a basis of making decisions on whether they lend you any money. So be very, very careful if you're self-employed, how you choose to present your finances to banks. You must see this all the time, Eva.
Yeah, all the time. So you have to choose. And I guess people understand eventually that they might have to pay higher tax for a year or two. get their finance sorted, aggressively buy properties, and then maybe go down the strategy of claiming more and reducing the taxable income. But yeah, definitely if on paper anyway, your income is low, it's going to be hard to borrow anything.
Yeah, and a lot of people go, "Well, that's not fair because I actually really make this much money." We go, "Well, you should be paying more tax then." Thank you very
That's
much.
right. That's right.
And
Yeah.
you've got to sort. This is really strategic. And you know, I don't have an advice for you on this at all. What I would say though is that be very, very aware if you are self-employed. If you want to maximize your borrowing capacity, get used to the idea of having to pay some tax.
Yeah,
Go and
even
speak
for
to your
just
accountant.
1 year, if it's just 1 year, some bank would
No,
take
pay
1
your
year's
tax. Everyone
return.
should be paying tax. We need the tax receipts.
All right.
We need the tax receipts. But your accountant, so this is why you need a really good accountant that actually understands property, but also understands business, right? That's it also when they view, in terms of increasing your borrowing capacity, if you're showing good tax, if you're self-employed in a company that you're connected in with, yes, you're going to have to pay tax on that. And you might not actually realize all the money from the profit you create in your business, but lenders take retained earnings. They take the earnings inside of your company, even if you don't pull that money out, it stays inside the business as borrowing capacity, don't they?
Net profit, yeah, of the
Net
year.
profit.
Yeah, that's definitely
So if
useful.
you make, let's say hypothetically, $3 million of net profit and you took home a salary of $500,000, in very broad terms, a lender's going to assume your earnings at $3.5 million as your ability to essentially service debt. Is that correct?
Well, yeah, depending on what percentage of the business you have and other factors.
I'm assuming you've got
100%.
You've got 100% of the business.
Yeah, that's right.
Yeah.
Most lenders will look at net profit as income. Yeah, for sure.
Yeah, and this is the key thing. If you are a property investor looking to maximize your borrowing capacity, you need to view it this way. So you might only take $500,000 only. It's a lot of money. You might take $500,000 in salary or PAYG income or however you choose to frame it. But added to another $3 million in profit, even if you keep the profit inside the business for other reasons, you're showing $3.5 million. Now, if you're talking 6 to 8 times your earnings, that's when you start thinking about, wow, the banks will have appetite to lend me a considerable amount of money. Starts getting really, really strategic. But that's at one end of the spectrum. Increasing your borrowing capacity for the lion's share of Australian investors is a lot more tactical and tangible. Let's have a chat about that, Eva. I will just go to a quick break. Stay with us back in a moment. Welcome back. Phil Tarrant for Smart Property Investment, chatting with Eva from Finni Mortgages. That's finni.com.au. Conscious that we're sort of chatting about some accounting functions here. I'm not providing advice in any way. I would make recommendations that if you are self-employed, you do show profit and pay tax on that profit. Go and speak to your accountant. But for everyone else, Eva, what's some other ways that you can really help increase your borrowing capacity?
Yeah, so I get a lot of people would have credit cards or car loan, personal loans. Even if they're not big, they could be $5,000 to $10,000, open there just because they needed a car at some stage or a little bit of renovation or going on holidays, whatever it might be. It might seem like a small amount compared to borrowing, $500,000-$600,000 for a property. But that really affects servicing capacity because most of the time it's $500 to $1,000 a month for a car. Most people, that's roughly the repayments. And if your servicing is tight, every dollar really counts. So if you do have debts like that, that's the one you should really try to pay off as soon as possible. And I also get asked often about Easy Pay, Afterpay, and all these Afterpay system for people shopping online. So I understand, there's not really any interest payable on those for a long time anyway. But the thing is, when you do get those, you get a credit limit opened, and that's against your name. It's in your credit history, and it's affecting how much you can borrow. So the less of those you have, the better. And the one I get a lot of argument actually with is the novated list, where people really think they're getting a good deal. It's pre-taxed. I'm getting pretty much my car for free, so they think. And that is actually not really what's happening. And that's often something that kills how much you can borrow for property. So all those unsecured lending, I guess, are the one that needs to go first.
What about HEX debt?
HEX debt as well. Yep, that's one same thing. There's no interest on those, but it's CPI indexed every year. And the more you earn, the more you technically pay off that debt. So if you're getting to a point where maybe you have 2 or 3 properties and a good income, the monthly repayment for the HEX debt will be quite significant and would definitely affect how much you can borrow. So yeah, another one to get rid of ASAP.
Yeah, and what we'll do, we'll put a lot of this up on smartpropertyinvestment.com. There you go and check it out. We'll pen a piece around a lot of this really great information from Eva. Another really good way to increase your borrowing capacity, Eva, is probably make more money, get a pay rise. Probably a good idea.
Get a pay rise, that helps.
Yeah.
The other thing is, we can't do much, but your base income is your base income, and that might not be easy to change. But if you get extra income like bonus, commission, allowances, maybe a car from work, these sort of things, some lenders might just say, no, if you get a company vehicle, we don't care. It's just something you get for free. We're not going to add any value to that. But some bank will say, well, actually, you're saving on money having that car. So we're just going to add $5,000 to your income just because you get that vehicle. So little things like that, can sometimes get you to the next property.
Yeah, and these are where different lenders have different policies and why, it's one of the key reasons why you should be using a mortgage broker, because if you go directly to a bank, they're probably going to view you differently. They're only going to have a handful of products potentially that they make available.
Yeah, they only have one policy. Yeah,
every lender's policy is different, where they go, oh, well, you've got a company car, we'll give you another $5,000 on your earnings, so therefore you can borrow more money. That's all cool. It's down into the interest. We spoke about rental income as a really good way so if you are a property investor and you are investing in property, is another really good way to show your income, plus some of the other areas we spoke about income. Another key area, Eva, for maximizing borrowing capacity is really around living expenses. So if you're serious about investing in property and investing in more property, you've got to be comfortable with your household budget. If you're spending a lot of money and you go, oh, it's okay, when I get an investment property, I'll stop doing that. Let me tell you what, you won't. Most people's living expenses are hard to curb. You will maintain, if not increase, your living expenses over time. So if you're serious about investing in property, do yourself a favor and start living as though you have another loan or another mortgage or another investment property as part of it for some time before you even start thinking about buying. That said, Eva, lenders want to see that also reflected in your bank statements, don't they?
Yeah, that's right. So for compliance, some banks will only ask for one month's bank statement, but as brokers for compliance, we have to check 3 months worth of living expenses and use the average of that. So it's really important. And for at least 3 months, you can, I think it's a long time. It's long enough anyway to really show what you can do or can't do sometimes. But what's important to understand as well is banks are using a system called HEMS, that stands for Household Expenditure Measure System. And it's based on how much you earn. And, let's say you're a single person earning $80,000, they, expect you to spend $2,500 a month, for example. Or if you earn 180, you expect it to spend $3,000 a month. If you're already in that sort of budget, there's no point for you to spend less than what you are, because they will use that higher figure anyway. But what you need to understand is there is some spending categories that are actually on top of that, which are not included in that HEMS, as they call it. So if you got private health insurance, if you send your kids to private school, if you pay child support, if you've got a second or weekender that you go to on the weekend, all those expenses are not what we call primary or needed expenses, and that's on top. And there are those that you should look at and make sure that what you're spending on top of what's needed is actually needed.
Yeah, so essentially they try and make it easier. They cookie cutter people and go, well, you look like this, therefore this is what your basic spending is, based on years and years and years of analysis of how people spend money. So if you're already in that band, you're probably doing okay. It's when you're over and above that, you need to start tinkering around the edges. And that's critical. You've got to live as though you have another loan before you start doing it, because it's very, very hard to change it. And living expenses, and banks look at this, the power of data matching right now. If you're having Uber Eats every night, or you're at the, concerts and at the footballs and spending money on entertainment all over the place, they're going to go, well, you're going to continue to do that. And they're going to assume you're going to do that. And even saying, no, I promise I'll stop when you give me a home loan, ain't going to cut it. So you got to show. So, Eva, just conscious of time. So the 3 key pillars then, for just to summarize this, and we'll follow up on smartpropertyinvestment.com to you about increasing your borrowing capacity. One is to increase your capacity. That's at the income level. So make more money, go and get a side hustle, go and drive Ubers, go and do whatever. And I'll tell you what, if you have a side hustle, get another job, guess what? You'll probably spend less money as well, right? So you get a double upside of that, because if you're out busy driving Uber cabs on the weekends, you're not at the discotheque drinking $50 cocktails, which is what they're worth these days. So increase capacity, go and make more money, or try and make more money with another job, or try and change your career, do some further education, do all this sort of stuff so you can uplift your salary. Number 2, start thinking about other income you can generate, rental income, etc. That's really, really key. Increasing borrowing capacity, get rid of non-secured debt first, dump it, get rid of it. And you'll be surprised, and a mortgage broker, even her team, will run the scenarios for you, just how much unsecured debt will shape the bank's ability to lend you money. It'll blow your mind when you start breaking it down. And even if you have a $40,000 credit card and you pay it off every single month and you never have a balance that goes more than $5,000, the bank's going to say it's $40,000 because you have access to that. So another really good way also when you look at non-secured debt is to reduce your credit card limits to a point where you need it, because if you have 2 cards at $40,000, the bank's going to assume you got $80,000 access to non-secured debt, and that's really going to hamper your ability to borrow money. And the third thing, living expenses. Start living as though you've got more mortgages straight away. See if you can do it. If you're comfortable with that, do it. Now, to summarize all this sort of stuff, if you want to borrow more money and have greater capacity, spend less money. It's really, really simple. Mortgage brokers can help you out. Eva, what's the best way to contact your team?
You would need to go on our website, finni.com.au, and click contact us and enter your details there, and we'll be in touch.
Yeah, there's a whole bunch. There's another whole aspect to this, Eva. Maybe we can pick it up next time we're here.
We could do part 2.
It's the structure in which you invest in can really change also your borrowing capacity as well, whether you're investing in trusts and all this sort of stuff. Again, it's an absolute game changer. So we'll do number 2, but this is really key. This is actual functional, practical ways you can increase your borrowing capacity. And if you want to invest in property, that's probably a good thing. Eva Loisance from Finni Mortgages, finni.com.au. Thanks for your time today. Always enjoy it.
Thank you so much.
Nice one. Thanks for tuning in, everyone. Remember to check out smartpropertyinvestment.com.au. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.